welcome to Street Check, the weekly podcast from Cabot Wealth Network, which has been in business since 1970, delivering investment research ideas and stock picks for more than half a century. I'm Chris Preston, Chief Analyst of Cabot Stock of the Week and Editor-in-Chief of Cabot Wealth Network.
And I'm Brad Simmerman. I'm the Chief Analyst of the Cabot Wealth Daily, and I'm the web editor here at Cabot. This week, we are going to discuss the ongoing market pullback, the disappointing response to earnings season, and then we're going to break down what some of the doomsayers have been saying, whether they should face accountability. Are they generally right? Are they wrong? We'll get into all of that.
Should they have to eat hot sauce for every wrong take? That's my question. I can still taste it on my tongue from last week.
I mean, we'll get into it, but just the volume of takes, they'd be drinking hot sauce every day.
Yes, exactly.
That'll be the crux of the argument, but we'll get there.
Yeah. And then, I believe our featured segment today, no guest today, featured segment will be on what's happened in China recently. We haven't really talked a whole lot about China. Obviously, it's been in the news, bit of a struggling economy at the moment, sluggish economy at the moment.
Yeah, and so much ink has been spilled on the sort of post-COVID lockdown reopening, the Great China reopening, and how that was going to juice the global economy, and how we're not seeing it. The Chinese consumer seems to be struggling, failing to pick up the pieces. But again, we will get into that a little bit later today.
Yeah, and first we'll lead off as always with the defend the take, which this one isn't a measurable one from you, so this won't be going into your gullet in the form of hot sauce. There's no wrong here, or at least not a measurable wrong. But your defend the take, for which you have 90 seconds, Brad, today is: the party is over for the U.S. consumer, and there's a hangover coming. You have 90 seconds. Go.
All right. So you and I have spoken quite a bit about the resilient consumer, the spending trends, how that's impacting retail spend, how it's impacting travel. There's been this underlying current of sort of a YOLO economy, right? Like you only live once. We were locked up for 3 years, 2 years, sort of depending on where you were. But people are spending on travel. They're taking the once in a lifetime trips this year. That's sort of anecdotally been the notes, but evidence is sort of growing that they are doing that in spite of toughening economic conditions, and not because their economic situation is actually significantly improved. I will say off the bat, Bank of America is showing savings rates are at 30% above pre-pandemic levels. So there is still excess cash. We talked about that with the money market fund balances. But what we're also seeing is credit card delinquencies at 7.2% now, auto loans, I think specifically subprime at 7.3%, which are both back up to pre-pandemic levels, above pre-pandemic levels. Actually, credit card balances just broke 1 trillion in the US for the first time ever. We also had earnings reports from TJ Maxx companies, discount retailer, and Walmart that we're showing that consumer spend is up there, but there's a lot of deal-seeking behavior. And at the same time, spend on Target and Home Depot, which are, they're retail peers, but they're a tier higher than those discount retailers. They missed sales targets. So we are starting to see evidence that the resilience...
You can finish it.
All right, I'll leave it with this. So we're seeing a bend but don't break consumer right now. We still have some excess savings, but spending is starting to get the feel of, I know I can't really afford this, but I'm going to do it anyway.
Yeah.
And I think we're starting to see that play out in retail trends as well. So I think that we are reaching the breaking point for the U.S. consumer, and if we have another quarter of super high interest rates, if the Fed's continuing to raise, mortgage rates go higher, that could spell some bad news for us.
Yeah, I mean, this is the Fed has got to be seeing this. They're still out there saying, well, we might not be done yet. And I know they can't be definitive about it, but I think they should be done. One more. It feels like the last couple rate hikes have had really no or little to no effect on the economy. But maybe from a lot of the data you just showed us that, maybe there is a sort of a slow trickle that is, or slow drip that, a few more drips and might open the dam in terms of, the U.S. consumer.
Well, so one thing that Michael Brush of Cabot Cannabis Investor brought up at an editorial meeting earlier this week was that it's an 18-month time frame for rate action to start actually hitting the economy, which we're sort of lining up with right now. The earnings season which again we'll get into further. The earnings potential of an earnings recession maybe showing its signs and then worsening into the fourth quarter. I've seen calls for a mild recession at the end of this year, then going into next. So it's always tough to make predictions, and coincidentally, we'll talk about how hard that is later. But it's tough to make predictions, but it does feel like we're starting to feel the bite of these higher rates, and they're trickling through to consumers who are not necessarily running out of excess cash and excess savings, but are starting to slow their drawdown on that.
Yeah, if you watched last week's episode, then you can see how hard it is to make predictions. And by the way, maybe this is measurable enough. If holiday retail sales, explode or like record highs or whatever, Black Friday sales, things like that, then there might be a way to disprove this, but it's still a good theory.
Yeah, it's convenient that you brought that up, because that was something that I was thinking about while trying to devise a take to defend. We spent 2 years inside buying everything that we wanted, and now we all have pretty much what we want, so we're spending on travel. Yeah. And then once we're done with that, it's like, okay, well, it's time to reprioritize paying off debt. The student loan repayment issue coming back in October, that is going to be pretty unpredictable. That's a lot of the excess savings may be coming from there. Yeah. So I think if we want to put find some measurable criteria for it, I think the holiday spend is a meaningful one.
Yeah. All right, let's move on to our big three. Number one is the market. Right now, this has been a tough August. We're only 3 weeks in. It feels like 3 months. S&P down. Speaking of wrong takes, again, good thing we recorded this last week. S&P is down more than 5% now from the highs, which were July 31st. So this month, down more than 5%. NASDAQ, 8%. Oh. That is a real pullback. That's like correction territory, especially NASDAQ. We felt it. Mike Santolo, our growth stock expert, has written about how, growth stock, you can feel it in growth stocks. You could a few weeks ago, before the market was really pulling back too much, but now it's spread to all corners of the market. So after the huge run up in May, June, July, we're saying we could really use a pullback. Pullbacks are healthy, would sort of reset valuations, things like that. And now we're like, it's like, whoa, maybe not that kind of pullback. But there's a data point from Rich Howe, our colleague who runs Microcap Insider, that the average pullback in the S&P since 1950, the average pullback in the S&P after a 15% run up, which is what we had, or more than that, is 8.2%. We're at 5.2 right now. How concerned should we be with this pullback? Is this garden variety, healthy ultimately? Or are we headed for a much bigger correction here?
The consensus from, certainly the Cabot analysts, and I think many economists and many market followers, it seems to be that this is sort of normal until it shows us that it's not.
Yeah. Still way above the 200-day line, which was that was the resistance point for all of last year during the bear market, or most of last year. We're below 50-day now, but still way above the 200-day, and well above the lows from March. And the pattern has been since October, goes way up, pulls back, but not nearly, or not to the previous lows. The new lows have been consistently higher than the
Right.
previous ones. So I think for the S&P, that would be right around 4,050 range, which right now we're, mid 43s.
Yeah.
So yeah.
Yeah. The thing that maybe raises yellow flags for me is how thinly traded the rally was, right? All the cash on the sidelines, institutional participation was pretty low. VIX was low. There wasn't a lot of hedging. There was a lot of what felt like wait and see from some of the big institutional investors. And a lot of the run up was driven, I think, by retail. Obviously, there's some measure of institutional buying, but that would be my concern, is that it would be that the rally was never as meaningful as the percentage change has been, right? Whether or not it's actually signaling a sea change in how the market is going to move. That would be my fear, but we're down 5%. It's nothing.
Yeah. I mean, well, I'll just leave with this. No new bull market, which this one, as you could say, it started last October. I think we have been saying it started last October. No new bull market this century, or going back 30, 40, 50 years that I could find, has fizzled in the first year. It fizzled in the first 5 years. So it would be surprising. The closest was 16% pullback in 2010, after the 09 post-recession rally.
Yeah.
It wouldn't be crazy to go beyond 10% here, 20%. To just immediately revert to a bear market would be surprising to me.
Yeah. So I think maybe the headline takeaway is, could we have another 10% correction from here? Yeah, sure. But are we going to have a 20% market, like a 20% sell-off? Probably not.
Yeah.
I think that's probably my summary line on it.
Yeah. Okay, let's move to number 2 in the big 3. Let's do an earnings wrap. Sort of tied. I mean, all the earnings blowups, especially among high-flying growth stocks that actually beat, was sort of what I guess was the excuse for triggering this pullback. But maybe the market was looking for any excuse to sell off. So FactSet projected, or their data showed that economists were projecting 7% decline in earnings growth year over year. It ended up being around 5%, so not as bad as expected. There are more earnings beats than usual, but the rub is that it was the worst response to earnings beats in more than a decade, since the second quarter of 2011. Stocks that beat EPS estimates were on average, and these are stocks in the S&P, were on average down 0.5% in the 2 days before earnings and two days after earnings. So that's frustrating and not normal. What do we take away from this earnings season?
Well, so, it just occurred to me, given what we've been talking about, if this is really more of a momentum-driven rally and potentially a retail-driven rally than a fundamental or valuation-driven rally, it would make sense that even an earnings beat is not reflected in share prices, right? If I'm buying on PE multiples and a company comes out and raises their earnings projection, I'm going to buy more until the stock gets back up to that PE level. If I'm trading purely on sentiment and momentum, I don't really care about those valuation metrics. I don't care about the earnings beat. I care about the share price reaction. So I do wonder if some of this is coming from what we just finished talking about, which is maybe a little bit of a thin rally, and stocks being driven more by sentiment and momentum than really by their valuation and fundamentals. I think most valuation-based investors are looking at short-term treasuries yielding almost 5% or CDs yielding 5% or more and saying, oh no, that's an adequate return for my investable cash for the time being. So maybe they're parked on the sidelines a little bit and we're just seeing the momentum growth traders. But we've also seen a lot of conversation around a rolling recession, right, where it hits different segments of the economy at different times. If that's what we're wading through right now, we could have another couple of quarters of like shaky earnings reactions without fundamentally changing without requiring that the economic picture be fundamentally changed. We could just see like for the next 12 months, say just some sectors are missing, some are beating, and where it's going to be very company specific as far as what your kind of returns you can hope to generate.
Yeah, I mean, if we have another couple quarters like this, that probably reflect what you were talking about, party being over for the US consumer. So the next quarter in particular will be telling. I think if stocks were not hadn't taken off the way they did in June and July, I wonder if some of the earnings blowups would have been more muted, especially the earnings beats. Earnings were down 5% this quarter. That's certainly not nothing. But I think that was somewhat of a convenient excuse for people to sell out of positions that they had made money on and were ready to sell high on.
Yeah, and I do wonder if maybe we still have some bad behaviors from the 2021 market, which was the sort of most face melting rally I've ever seen as far as hype and speculation, where it's just it's up only. Everything is up. Crypto is up. Small caps are up. Large caps are up. Dividends are like everything is up. Now, to be fair, I was 16 when with the .com boom, so I wouldn't have experienced that. But this certainly has been a more exuberant market than anything that I've seen going back to the great financial crisis and to a couple of years earlier. So if we've got a combination of maybe some bad behaviors that we need to forget, and we've got really, really impressive stock returns in the first part of the year, I can see how that would lead to earnings disappointment and pullbacks even on beats. And again, especially if it's not valuation driven, especially if it's momentum driven.
Right. Yeah. So we'll keep an eye on that, especially when the next earnings season arrives. Number 3, this one is more your baby. I'll let you take the reins, but you want to talk about all the doomsayers out there, Michael Berry, Dr. Doom, others. Some of they're back at it again. What have they been saying lately?
So this was prompted by Michael Berry putting 1.6 billion into S&P and NASDAQ puts for the year, and 2 or 3 days into the trade, or whenever he actually entered it versus when he disclosed it, he's right.
Michael Berry, who famously called the subprime mortgage crisis and made a lot of money on that. Yeah,
made a fortune on CDOs.
If you watched
Big Short,
read The Big Short. Yeah, go ahead.
So and then Dr. Nouriel Roubini, who goes by he's got the moniker Dr. Doom because it's a sort of sky is falling constant patter from them. But you and I were talking about this with Ed Coburn, the president and publisher of Cabot, in the context of our own podcast recording, where it's like, hey, we come out, we make wild calls, that's the bit, but we're also paying a price for them. But so many of the doomsayers make their stock and trade in coming out and making outrageous, catastrophic calls, and then they make the rounds on the talking head shows, and they never face consequences. They never pay a price. So I thought it would be useful to maybe see what we can do to go back through some of these calls that have been made, and introduce some accountability to it, because it's one thing to make a prediction and then just abandon it, right? Like there are real people that are investing real money that they worked hard to earn based on what some of these guys are saying, and it does reek a little bit of some of the short seller sort of negative hype, like your Citron researches, which I used to think was actually fairly reasonable and pretty good, but any kind of concerted short effort, you benefit if people are selling. So if you can inspire fear, there's a market advantage. Now, Michael Berry famously on Twitter, now X, would post his takes, his calls, his predictions, whatever, and delete them after the fact. in March of this year, he tweeted the word "sell" to everybody that was following him.
Yeah.
And then we had, the awesome summer rally, and maybe in hindsight he'll turn out to be right. But these are guys that got one thing right like 15 years ago and have been profiting off that since.
Like Jeremy Lin.
Yeah. It's
Sure, everyone got that. Yeah.
So I was looking at, I was going back and I was looking at some of the predictions. A couple of things actually sort of caught me off guard. In 2014, Rubini was pointing to ongoing difficulties in the Ukraine as being a potential market destabilizer. And now at the time, Russia had invaded the Crimean Peninsula, or had covertly invaded it and was beginning to annex territory. So it was very top of mind. Another thing that he predicted in 2014, fears of a Chinese slowdown that spill over into advanced economies. Right. That's not really a material call, right? That's a persistent and prevalent and prevalent market fear, and they're simply catastrophizing them.
Yeah.
Michael Burry in 2021, he actually was pretty good. He did say index funds are like subprime CDOs, collateralized debt obligations, which were the things that blew up in the great financial crisis, which is a bad take. But he did recommend in December of 2020 issuing an additional 25 to 50% of shares because the stock was so overpriced. Now, Tesla did rally and did run an additional 38% from when he made that prediction to their all-time highs, but shares are 26% below that now. So that would have been sort of a good move. The Tesla rally and the stock market rally of 2021 being similar to past internet and housing bubbles, that's not totally a wrong take. I mean, we all remember sort of the GameStop saga, the crypto craze. Barry said speculation and betting have driven market to brink of collapse. That's wrong. The market was never at the brink of collapse, but it's just a catastrophized version of an actual sort of reasonable approach, which is, in 2021, there was a frenzy there. Robinhood sort of democratized investing in a way that we hadn't seen in the past. The internet, the Wall Street bets, all that stuff. In hindsight, with 2 years in the rearview mirror now, there was, I don't know, maybe 70% of that 2021 rally was bubble and hype, and maybe 30% was real. So my original pitch was that this would be sort of a hit piece on how bad these guys were at making calls and making predictions. But my takeaway is they're really not that bad. They're probably in the coin toss range. We talked about Jim Cramer being a coin toss, having coin toss accuracy, but they hyperbolize and they catastrophize. Yep. So, there's my grand take.
It's good for clicks. It's good for clicks. It's good for attention for them. And I don't want to poo-poo the guy who called the subprime mortgage crisis. I mean, you got to take him seriously, and it sounds like he's still getting some things right. But I wouldn't invest based on their doomsaying headlines, because there's so many of them. It's Stephen A. Smith is just like a geyser of takes, and some will be right, some will be wrong, but I wouldn't take them as gospel.
Exactly. They're side effects of the sort of attention economy, of the constant need to have eyeballs on stuff, but they're not going to be any more right or wrong than anybody else at making these predictions. There's a reason that we're not in the prediction business. We propose a theory or a thesis, we advance it, we put money on the line to test it, and then it's right or it's wrong. But what we're largely not doing is coming out and saying, okay, well, it's definitely, the market's definitely going to go here, definitely going there. We don't know, and nobody
does. The certainty and sort of the arrogance that comes with it that really can rub people the wrong way, especially when they're wrong and don't even acknowledge it. But Okay, so yeah, take those with a little bit of a grain of salt, maybe several heapings of salt. Let's move on to China. Bad week for China. Uh, let's see. So their central bank cutting rates.
Yeah.
Youth unemployment is 20% now.
21.3% was their sort of terminal rate of youth unemployment. And I call it the terminal rate because when they announced those numbers, or after announcing those numbers, they came out and said they will no longer report youth unemployment because the party line is the assessment is not good enough because of how it tracks and counts students that are still enrolled in school but are on a break.
Yeah.
But if they're job seeking in the US, we count them 16 and over actively looking for a job, and you're on the jobless rolls. So we would count that in the US if we're doing a 1-for-1 comparison.
So basically, the just from 10,000-foot view, the Chinese economy is not having it's not the immediate party that people thought it would be right after coming out of their draconian multi-year COVID lockdowns. It's more sluggish than that. It's more methodical and disappointing, frankly. How much of a concern do you think this is for U.S. investors? How much of a long-term do you think this is China's fate for coming months, years, or do you think it's just taking a little longer for Chinese consumers' confidence to be restored?
I am more okay. The first for the U.S. investor thing, weakness in China could lead to lower prices for us. Right, like they're a huge manufacturer, a huge consumer of natural resources. If their demand is lessening, that makes resources a little bit cheaper for us. So if we're honestly pursuing as a national economy onshoring manufacturing, that would be good for us. For the American consumer, you're probably getting less cheap Chinese goods, but do we want those? Right? One thing that I've been thinking about with China is they had been behaving as if the thing that worked when they first sort of capitalized their economy, which is real estate, they are highly leveraged to real estate performance. It's 30% of their GDP. By privatizing real estate ownership, it was indirectly a massive injection of wealth into Chinese consumers, who then became more affluent, and they started adopting more manufacturing and less agricultural business. But that only works as long as you have more money coming in. And in the first quarter, direct investment by foreign nations and foreign investors was only 20 billion compared to 100 billion a year earlier. Household debt for the Chinese consumer is rising. Their producer price index was down 5.4%. It's sort of signaling possible deflation. And the economic conditions are causing Chinese consumers that are still doing well to become net savers instead of net spenders. There's a 12% increase in mortgage prepayment in the latest figures versus a year ago. The reason that I flag that is, like, you and I can go and refinance a mortgage. You can take a loan against a property that already has a loan on it to pay off a loan. That's unlawful in China. You can't do that. You can prepay a loan. So if you see that, say, interest rates are coming down because they're cutting rates, you are now paying above market rates for loans that you have outstanding. So the prepayment of loans is the closest you can get to a refi. So if the Chinese central government is going to be cutting rates for a little bit, it's incentivizing consumers to remain net savers, because many of them have oversized mortgage obligations because real estate's 30% of the Chinese economy. So they're directly incentivized to pay those loans down. I think the impact on the U.S. investor is going to be really muted over the last 3 to 4, I guess 4 years. We have sort of increasingly distanced ourselves as investors from China. The Vanguard Global Stock Investing Fund has like a 3.8% exposure to China or something along those lines, despite the fact that China is the second largest economy in the world. So U.S. investors are fairly well insulated from China. I don't know. I'm sorry, I just stepped on.
No, I was say, so the IMF, still a National Monetary Fund, still, I don't know if this past week has changed their calculus. They list China as the biggest driver of global growth over the next 5 years through 2028. They still have confidence in China's recovery, at least in the long term, intermediate term, whatever you want to call 5 years. I think while it's clearly taking, it's not that they're not just being shot out of a cannon post-COVID like a lot of people thought. I do think, you talked about the potential for China. We were off mic before, potentially going the way of Japan in the 90s or whatever. Yeah. I don't see that. Will China have the same kind of growth that it had, a decade plus ago? Maybe not. But I do think it'll get back to at least a reputable growth and a meaningful growth that does help drive the global economy. Would I invest in Chinese stocks now? Not many. There are some. I've come on here and said several times, one of my favorite stocks is BYD, the EV maker, China's actually biggest automaker. It's sort of the Tesla of China. Ticker symbol BYDDY. That's pulled back a bit because of all this China news, but that's been growing like a weed. They tripled revenues last year and up 70% the first half of this year. So I think you can pick and choose, but I would definitely be cautious with Chinese stocks. Very, very selective now and for a while. Especially while the country's still trying to figure out how to get consumer going again.
Yeah, my big picture takeaway is China has been something of a knockoff economy, right? Like I say that not to be totally disparaging, but for the most part, what they did is they looked globally and said, okay, what worked in these different economies to boost their economic productivity, and how can we implement that? And then they operate on a 100-year plan. So Beijing can make plans and projections in ways that the US can't. But we're increasingly seeing the sort of wheels come off with a lot of the Chinese economic activity. If you look at the Belt and Road initiatives in the global south, where hydroelectric plants are sort of failing and falling apart, and they're not realizing the value that they were expected to. Major real estate developers are failing. We had Evergrande default, and then we've got Crystal Gardens now that's sort of at risk of defaulting because they came out and they produced a ton of homes that nobody wanted. Even if you think about consumer practices in the US, when you're buying stuff from Chinese drop shipping firms on Amazon, you're mostly getting subpar, lower quality products. I think China's in a show me phase economically, where it's like, okay, well, the knockoff thing got you from A to B, but you're going to actually need to differentiate between product quality, between how much of an economic driver a company is. Like all these companies are now in show me mode. They've got the low hanging fruit, and now you're competing on sort of a global stage. So I do think that there's going to be a handful of Chinese companies that do really well, that execute, that are profitable. But in general, I think a lot of the easy money is sort of gone dry there.
Yeah, it's not, when I first arrived at Cabot, we actually had a newsletter. It's now called Cabot Explorer. That's just a global newsletter run by Carl Delfeld, who we had on here a few weeks ago, there was a newsletter devoted to China. It was called Cabot China and Emerging Markets Investor Timer or something like that. And it's become clear over the last decade, or a little less than that, that focusing just on China is not, that's a pretty limiting and risky strategy. It doesn't mean you can't invest in Chinese companies, again, like you said, and what I just said about BYD, but these aren't the days where, you know, China's economy is lifting all Chinese stock boats, like 10-cent holdings and Alibaba and you know, a bunch of Xpeng or whatever, a bunch of companies that that now you never hear about anymore. But
it's also always tough when you've got so much centralized control. If Beijing decides they don't want U.S. direct investment, they could come out and they could ban trading of U.S. stocks, right? That's one thing to be aware of if you're investing in China, is they can change the rules on you. So, you know, be diligent and limit your exposure.
Yeah. Okay. Well, that is it for us today. Thanks for joining us. A couple notes. If you have any questions for us or comments, again, if you want us to recommend the hot sauces from last week, streetcheck@cabotwealth.com is the email address. And again, please please subscribe to us on YouTube or wherever you get your podcasts. Give us a like, 5-star rating. It's a free podcast. We ate hot sauce for you last week. What do you want from us? Come on, it's your turn. Pay it back. You're not seeing Michael Berry or Dr. Doom guzzling hot sauce for every wrong take they get. Only get that accountability here.
Yeah. Yep. Yeah. And you gotta like, subscribe, and let us know if you like guests, if you like segments. Any kind of feedback is appreciated. Ultimately, this podcast is produced for you, the listeners, and you, the viewers. So the best way for us to know what to deliver is for you to tell us. So just let us know if you have feedback. We would greatly appreciate it.
Yeah. streetcheck@cabotwealth.com. Thanks for joining us, and we will see you again next Friday.
Bye.